Mutual funds are meant for individual investors, and many a times they are designed and styled and packaged as a consumer product. It's sold as a story. And investors get carried by that. They end up buying one thing or the other, and they end up being a collector rather than a focused investor.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, if you've been interested in equity investing or have been an investor, you would know the importance of diversification. It's the most important, the most valuable quality that mutual funds bring to your portfolio. And while too little of it can make your portfolio risky, too much diversification doesn't really make sense. So what is the right mix? Should you invest in some more funds or should you pull out of some schemes? What is it that your portfolio needs? We'll tell you in today's episode, so keep watching.
It depends. If you are going to start your investment journey and you can barely spare 500 rupees, one fund is good enough. As your scale grows, maybe you should add some more funds. But for any sum between 500 rupee to 10,000 rupee, starting your SIP, one fund is good enough. Then comes, once you have accumulated, then you need to spread your investment simply because you want to de-risk yourself from a fund manager doing poorly. And with that in mind, I think once it becomes sizable means I would say that, something like 5 years worth of investments, savings that you have. Because that is the time period in which it actually becomes very meaningful. And if you are hit with if you end up with a fund which is questionable, then diversifying across skill is just as important. So 5 years worth of investments. Once you have that much of accumulation, then spread it over at least 2 to 3 fund managers. You are investing in a flexi cap fund, you are investing in a tax saving fund, you are investing in a multi-cap fund. But spread it over 2-3 fund managers, because best of fund managers go through lean patch. And if you have all of it in 1 or 2 fund only, so concentration is risky here. But I think the bigger problem that we see on Value Research online portfolio tracker is that people end up being a collector. They have just too many funds and they end up buying some fund or the other which is getting launched. So they end up with a tax saving fund or this fund or that fund, some thematic fund from sectoral fund. So it's very important that you keep it straightforward, have few funds. And I think for even a very sophisticated portfolio, that can be met with no more than 4 to 6 funds. You should not have too many funds for a variety of reasons. One is that you should be thoughtful before you are investing. It's not a casual activity. You know why you are buying a fund, why you are investing in a fund. Then any equity fund, it requires long-term commitment. Long-term commitment because you should not invest at one go. And you should be holding it for a long period. So it should be a thoughtful activity. The second is that you should not buy into any casual story, because mutual funds, as and when they are launched, they are sold as a story that this will work the coming season. You don't invest for the next season. You invest for your retirement. You invest for your child's education. You invest for many years. That is the goal. So you should be careful. The point is that being thoughtful about it makes you a serious investor. Third reason is that when you end up being a collector, when you have too many funds of varied kind, then you are too diversified, and without a plan, you are incurring the cost of an active management. While you can have all of it at a very low cost index fund, because if you invest in an index fund, a BSE 500 or a Nifty, that is available at 10 basis point or 25 basis point or 50.5%. And when you are investing in an actively managed fund, it is costing you 1.25% or 1.5%. It can well go up to nearly 2%. So that is the kind of cost that you incur. And if you overall, by virtue of having your multiple fund, you end up by being almost like an index fund. What's the point? Might as well, incur low cost and optimize your returns. Reorganizing your portfolio requires two things. One is that you should apply your mind in terms of when are you likely to need the money. It is always a good time. This is an exercise which you should be doing every year. Is it going to be 5 years and more? Is it going to be 10 years and more that you are unlikely to need the money? Then you decide on the allocation. If you have accumulated a sizable sum, you have been investing for 5-10 years and it has become meaningful, then decide which are the best funds and which are the most diversified vehicle, and try and emphasize that. Pick 4 of your best performing diversified equity investment and consolidate your investment into that. And everything where you have a nominal investment, something which is less than 5%, that should be the first one to go. The other starting point could be, the funds which are 1 and 2 star rated, because that is clearly a outcome of inconsistent performance over a period of time, which translates into very low rating. I'm not saying 5-star, 4-star funds are great, but 1-star and 2-star funds are definitely not so great. And once you are able to consolidate your sizable money into 3-4 funds, you will become interested. You will become interested in knowing and keeping track of how they are doing. And your long-term history with that fund itself will also help you remain a long-term investor, because your perspective will change. You will have the understanding that how bad it can get and how the fund bounces back. Identifying underperformers is, don't look at your performance only, because there is a possibility that you would have invested at a point which was catching a market hype. It could be a great fund, but it is not doing well ever since you have bought that. So I would say look at the value research page on that fund and how it has done in a full market cycle, a rising market phase, a phase of market when the market was going up and going down. And if it has beaten its benchmark, if it has done close to 5-10% plus minus its category, and this is a readily available information on each and every fund, hold it, then it's a reasonable fund. This is the way to look at it. Be objective with your numbers and don't get carried by the very precise performance, because many a times you invest in a fund and your investment becomes you are down 20% and you want to walk out of that fund in a huff. That may not be a good idea. We have talked about asset allocation and rebalancing quite a few times, but it's very important. It's very important once you have your accumulation becomes meaningful. When you are starting with your 5,000 rupee, 10,000 rupee and the initial years, 1, 2, 3 years, don't worry about asset allocation. Because asset allocation is a risk moderation mechanism for your portfolio. Once it becomes something sizable, once it accumulates to 5 lakh rupees, 10 lakh rupees, and that going down by 10-20% in a brief period of time will hurt you psychologically. That is the time when you need to plan your asset allocation. Broadly, if you are many years away from your goal and you are unlikely to need that money for many years, then you should be substantially into equity. And substantially into equity, it's very difficult to articulate. There isn't a precise formula, there isn't a thumb rule. But I would say that, a fourth of your money should be in fixed income, or a third of your money should be in fixed income if you are more conservative. Because there are two benefits of having this fixed income allocation in a long-term portfolio. One is that when the market crumbles, which it does every now and then your overall investment value don't decline as rapidly, as fast. And second is that once you have this big decline in equity which comes in, and you have this 25% or 35% of your money into fixed income, you will be able to rebalance it. And if you would rebalance it, you will benefit from it, because you will end up buying cheap the equity component, because when there is a sharp decline in a brief period, which always happens like that only, then to be rebalancing ensures that you are buying cheap. And broadly, for people, I would say that there are 2-3 allocations. In your accumulation phase, it should be nominally into fixed income, 25% or 35%. If you have gone into retirement, started consuming, and if you have been able to build a meaningful or sizable asset base, then maybe equally into equity and debt. That is something which will make it a real low maintenance and fairly rewarding portfolio. If you are ultra conservative, if you depend on your investment for for income, that is the situation when you should have substantially into fixed income. That is when you should have 2/3 of your money, or maybe 75% of your money into fixed income, depending on your income requirement. And why have equity in retirement? Simply because that is the only way you will have the inflation protection. Because if you invest all your money in fixed income and derive the gains that you consume, then you will be left with a constant capital, and constant capital will not be good enough 5 years from now, 10 years from now. So to protect the worth of your capital, you must have equity, but not all of it. So asset allocation is one part, but to benefit from asset allocation, you should rebalance it. Rebalancing, I think you should have broadly 2 rules, and we are working on Value Research Online, the portfolio tracker. We have a mechanism of setting up alerts. It's not ready yet, but we are testing it. It will be able to alert you on big swings in your asset allocation. If you have set up your asset allocation as 50-50, and if it becomes 60-40, you will get an alert. You should revisit your asset allocation every year, and you should try and rebalance if there is a more than 10% change in the stated thing that you decided. Jot it down in your diary, or keep a note that you want your asset allocation to be 50-50 or 75-25 or 25-75, whatever you choose to. But I think if there is a more than 10% swing in the asset allocation, if your 50 becomes 40, then make a change. You will benefit from that. And many a times you will have regret in the short run, because after you have made this change, you have made the change, rebalanced it, you will find that the market is still crumbling or is still going up, and you have lost a little bit of opportunity. Don't get carried by that, because this asset allocation and rebalancing is not only profit maximizing mechanism. It is a risk mitigating proposition. When you do this, you basically are insuring against a calamity in the market and trying to profit if there is a temporary decline that happens in the market.
Well, that's all we have for you in today's episode. Hope now you know how to trim your portfolio. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.